This is ChangeMakers with Katie Goar, finding the right solutions for the affordable housing community.
Today's Forbes Quadell Changemaker is Lauren Taylor Dreher. You are the founder and managing director of Bear Impact Fund, where you are reimagining affordable housing through a bold investor-backed model. And I'm actually very excited to have you here because you're going to bring such a unique perspective. You are a strategist. You have gone through several reiterations of resiliency, and you're what I like to say, a unique icon in what you've done and what you're doing. So welcome to the podcast.
Thank you so much. I'm so excited to be here. It's like, you know, I'm new to the affordable housing space and I've had such a warm welcome. And this is just more evidence of that.
We have talked many, many times, and I think it is a great segue. But what I appreciated when I was talking to you over these last several months is how your career has pretty much ebbed and flowed to where you are now.
Yeah. So I had a very glamorous start to real estate. My husband and I have been together for 18 years, and his background initially was in construction, and he was doing property preservation, which for anyone out there that doesn't know what that is, that's just a fancy way of saying cleaning out foreclosed houses for banks. And so this was right around the housing crisis. I was 20, 21 at the time, and we got some contracts with banks and started cleaning out foreclosures. As I was doing that, I decided, I wanted to get my real estate license because this is peak foreclosure time. So this is when the housing crisis was happening. And I got my real estate license and started doing REOs, which I found, no shade to REO agents out there. Like, it was just very boring, filling out paperwork and, putting out signs. And I read a um, Forbes or Wall Street Journal article. I can't remember the exact source, but the article was on how institutional capital was moving into single family rentals. And I was just like, oh, I think I would really like to do this. And so I spent a fair amount of time researching and trying to figure out who the players in the space were going to be. And then a conference popped up. That was the first annual conference for a conference circuit called IMN. Now they are, I believe, the biggest single family rental conference in the country. But at the time, it was a very small group of, kind of reminds me of affordable housing now. A very intimate, kind of like tight knit group of people. And I took a loan out of my car to go to Miami for the first year and started trying to meet people. And that kind of progressed into doing some acquisition work, where I was helping, an investor that was operating out of a shoebox in New York somewhere, and had raised capital, came out of private equity, raised some capital, wanted to buy housing, but wasn't quite sure what to do. uh, really sharpened my teeth as an analyst first. So that was, I say my core roots are as an operator and an analyst. I love that portion of the industry because it's really where all the magic happens. You have to source the property; these are physical assets, and so you need that ground support. Through the years, I was able to develop different relationships. They started small, and then I was able to attract kind of larger clients that needed more operational help. And as that happened, it naturally progressed into operations companies. And so my husband, who was working for a fund at the time, he came over. We joined forces again. He ran the construction division. I ran acquisitions and property management, and we went on I would say, 7-year cycle of recycling clients. Because in our space, if we did well, then we would lose the client eventually. We would get them to a scalable point, then they would pull in their operation and go vertical, or they would sell their portfolio, and then we would have to go find another client and do it all over
Right,
again.
right.
And so as we got into that, um I learned a lot. We had some faster scaling clients, which was stretched us in all possible directions. The last one that we had, we moved like 14 different markets or 16 markets in 14 months. And we were buying 100 to 150 single family homes a month
Wow.
between those markets. And so that was a full pass through. We would buy and renovate and rent out about the
Mhm.
same burn rate. And um, so yeah, I'll kind of pause my story there, and then we can get into the affordable housing side. I feel like I'm just like da 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 da, but I wanted to get you through the backstory as quickly as I could.
Well, a good transition here is, I believe in an Instagram post that your team and you were kind of like going from the real estate world, or your eyes were opened into the affordable housing world. So let me tee that up, and why don't you transition on that thread there?
Yeah, I think a couple times in life, timing just lines up in a way that's what it's meant to be.
Mhm.
And for me, that was 2020, and uh, which was I think a pivotal year for a lot of people for a lot of different reasons. And it just so happened that my last client that I was talking about let us know in February of 2020 that they were going to start internalizing their operation. And so I went from 120 hours a week, with 40 something employees across 2 states and, hundreds of contractors to kind of like breaks. And then COVID happened and I went even harder breaks. So we were sitting at home, not really knowing what to do.
Right.
And so I went into research mode because I knew, I think the biggest part was I knew that I wanted to escalate to the next level after I was done with that client. So I was anticipating wanting to raise capital in some regard. But when I went back to my analyst roots and started to look at the industry as a whole, and the industry itself is very stable. So SFR as an asset class is a very stable asset class. The issue for someone who has operated in the space and then wants to go into raising capital is that the timing now in the market is not what it was.
Mhm.
So if you're not an established player, this is just my opinion. I don't think now is a good time to raise capital. But more importantly, I got obsessed with trying to figure out how to pencil. Initially, it was workforce housing, and I started looking at workforce housing and how do you maintain healthier rental inflation over the course of time? Because when I first started in the industry 15 years ago, a property that I would underwrite in one of my neighborhoods would be, was 750, and now it's 1450.
Mhm.
So we've seen massive increases in rental inflation over time, and that's a whole different uh, bag to
That's
get
like an
into.
episode
Uh,
2, right?
yes, episode 2. But I really was interested in like how do you build a new model, and I was very sure at that point in time that it needed to be a different financial model that didn't currently exist.
Okay.
I think that the institutional space gets a lot of pressure and heat to provide affordable housing, and they do for the segments that they serve, right?
Mhm.
But they can't solve low income or especially extremely low income with the current models that exist for a variety of reasons. Their financing, their commitment to their investors, the equity component, there's a lot of things that make it difficult, taxes especially. And so those models don't work. And so I started looking at the space at large.
Mhm.
And the first thing that I did was go after a local housing authority contract. I wanted to see how affordable housing was working in that space, kind of get into the space to get more intimately familiar with it. And so we did win a RFP to manage about 700 units, and I learned a lot during that period of time. And I had a prior client that came back, and we went into some LIHTC projects. I learned a ton in that space. over the last 5 years. And my main takeaways were that the existing financial models that are in place, whether that's LIHTC, RAD, or any bond type product, is very slow moving. And especially from what I was used to, I'm relatively spoiled in the private equity space that we can deploy capital so quickly, we can create units so quickly, and so it taking 24 to 36 months to create 100 units was just like, "What? What is going on?" And so
You went from,
d
like, warp speed to baby steps, didn't
yeah,
you? Yeah, but it's
yes.
not but, your point is, like, it shouldn't have to happen like that, like, why can't there be the same mobilization that you're seeing on the private side? What's missing here on the affordable side, right?
Yes,
Mhm.
and these 2 industries have stayed in silos on their own. We just came back from the NARO conference, and one of the keynotes there, he was talking about like everyone stays in their lane, and
Yeah.
I found that to be very true in private equity as well, or in the institutional capital space. There's a kind of an overall lack of understanding of the affordable housing sector in that sector, especially in private debt, and the affordable housing sector doesn't have much crossover to, especially, like, if you look at individual nonprofits and how
Mhm.
they're trying to figure out how to scale housing. So I was really interested, like, how do you get creative with financing structures to build a model that could scale at the same rate? And,
Right.
that's how we kind of came up with the model that we're currently doing, which we can get into.
So let's describe this from the first foundation step. So you've got a private investment component, you've got a nonprofit component, and you have an operating arm. So I guess that is that the right formula for the model that you're using, and expand on why that model is created like that because it's very unique to have the blending of those three arms. Did we cover those or expand on those?
Yeah. So the idea here, one, you do have to get creative because there's not a whole lot of existing product. The goal here is to create a baseline that then can be replicated at large scale.
Okay.
And this fits perfectly into the large institutional space. And so our long-term goal is to find a uh, impact aligned institutional partner, that has potentially already has existing operations in SFR, or something of that sort. But how I came up with it was a lot of process of elimination. So when I started building out models, I can't even go through all of the different variations, but I had about 3 years of R&D. So I, um, tried penciling models, I tried looking, what would that look like from a capital raising perspective? What would the investor interest have to look like? And as I went through, I was inspired by companies in other sectors.
Hmm.
So B corporations were a big inspiration. ChatGPT, OpenAI was a big inspiration. People that were using hybrid nonprofit for profit models in order to solve bigger problems. And, that is, really what we're trying to do here because you have to do I think the interest has to be aligned in 2 big ways. One is it has to be scalable. You have to be able to acquire and attract a large amount of capital, and so that means you have to be a safe and viable investable vehicle. And you have to have something that protects the integrity of the affordable housing component in the long
Right.
term.
Right.
So the nonprofit aspect is what protects that. It does a few different things. It protects that, and it also gives you the tax rebate or incentive that you need to make the model work. Really, if the properties are owned by the nonprofit, then you get a tax abatement and on your property taxes. Those work differently in different states, but for the most part, an all or substantial tax abatement. That is really functioning almost similarly to bonds that you would find in other markets, but it creates way more flexibility, which is what I was looking for. I felt constrained
Hmm.
by the existing models and existing financing because it doesn't give you a whole lot of flexibility. For example, if I have a LIHTC property and we're talking about, we want to look at resident health and resident stability over
Hmm.
time, these existing systems have to be structured that way for a reason, so it's not for
Right.
nothing,
Right.
but they also constrain the resident pretty substantially.
Yeah.
So I like to picture it as stairs,
Hmm.
and our first step is like HUD housing, what used to be public housing that's transitioning now, and then you have like LIHTC projects, where they're income restricted, and so every year the resident has to show their income and they have to stay below a certain threshold or they are at risk of losing housing, losing voucher or
Yeah.
otherwise.
Right.
The issue is then that there is no stairs between that and market rate.
Hmm.
So moving from a controlled rent environment to the market is very difficult because there's nothing in between. And so we see ourselves as functioning as middle market uh in low income housing. So it's kind of if you're like, "Oh, middle market housing." Well, kind of, but we're just steps to get to true market rate.
Right.
And this is vitally important for the health of real estate long term. So this is a big conversation that we're having in the institutional space. I am very fortunate to be a board member of National Rental Home Council, which is the functioning kind of lobby and advocacy body of single family rentals. And that group is very interested in how to proactively solve this problem because it creates more stability in the market long term. They want for housing to
Mm.
be stable and for them to fill the need in the clientele that they're currently serving, but also have a way to fulfill a need in a completely different market segment. So there's a lot of interests that are aligning, and I think timing is very good because the need has never been bigger than what it is currently in affordable housing. But there's also a um, huge long-term concern with if we don't provide more stable, scalable models, that the supply is going to be which we can talk about supply in a minute. It's one of my favorite things to talk about. It's going to be a long-term issue that's going to only get exacerbated and larger as the market grows and continues to develop.
So the other piece of this too is that, when you mentioned that there's no real step to go from those income restricted, income managed to market, it gets very punitive too as your income is increasing, but you're not really able to do much the way the rent calculations are due. So you're almost, I mean, I say punitive in some regards, unless you're enrolled in like maybe a family self-sufficiency model or something like that. But where you have like an income disregard component. But what you're doing here is also not having that punitive component, if I'm understanding you correctly, right? So
That's right.
you're kind of saying, hold on, I can have some economic improvement, some rent stability, and prepare myself for that next leap to the market. Is that
That's
right?
right. The biggest component here is that you don't have regulated government restrictions on income, which is
Mhm.
very helpful. And it provides a great partnership between, I think we're kind of standing arm in arm with like, I'm trying to reach out to the NARO side of the world and say, as your clients progress out of and are having new opportunities and the programs that you have them in are
Right.
successful, which is ultimately the goal to move them further down the line. that they would pass them to us, and then hopefully long term we pass them on to the other side of the industry, whether that be homeownership or long term rentership.
Mhm.
Um, and I think that, you know, that's a whole, I think you and I talked about this, but it was a whole nother conversation of we are in a position now where we have to look at legislation and other things as being against renters to a certain
Mhm.
extent.
Right.
And there is a world that exists currently where it is okay if someone never wants to buy a home. They may want to, and if that's their goal, then we want to work with them to get them to a point where they can.
Yeah.
Or they may learn that they want to have different types of flexibility and stay in rentership. So there's a lot of different components there. I won't get down that rabbit hole.
And there's even some studies that are starting to come out that talk about how the rent caps, um, how those are actually reducing production in certain areas. So we still don't have quite that social policy, or we don't have that product yet to be able to recognize the income goals or income improvement of individuals at the same time. But I think that's what you're trying to do here, and what you're doing is that you're introducing a new model to both hit the personal pocket, hit that achievement goal for them, recognize the rent dynamics that private developers and owners are up against. So let's talk about supply then, because that's the other piece of this here, is that how you're wanting to create that investment opportunity to put units into the market and address some of that supply. So why don't you go ahead and take us down that rabbit hole about supply that we like to talk about so much?
Uh, so excited about this part because this is where if I go to NARO
Mhm.
or if I go to NRHC or IMN, whether I'm on the institutional side or I'm on the nonprofit side, the conversations at these
Yep.
conferences are the same, which is supply, supply, supply. Where is it
Right.
going to come from?
Right.
The issue with development is we deal with NIMBYism. We deal with, I ran into all of these things on the LIHTC side when I, ventured down that pathway, for a little bit, and because all of a sudden, if I'm going to put a bunch of housing in one place, it's gotta come out of the ground, it's gonna affect traffic, it's gonna affect, people in all of these perceived ways. But more importantly, I'll touch on this really quickly, there this is a form of separation that I think is we can do a better job at, right? Um, because in a lot of markets, and I know any of my tech developers, affordable housing people out there will agree, there are areas that they're like, yes. And then there's areas that they're like, no.
Meaning
So,
that they're like saying, yes, they'll go into, and no, they won't go into because they know the
yes,
battles or the zoning or whatever the things are. Okay.
yes.
Okay. Yeah.
Um, and the difference with single family rentals is that there is an overabundance of supply in the lower segment of the market. And this has resulted in for a lot of different reasons. And in most cases, it's because of the condition of the property. So, for example, if I'm representing a institutional client, that institutional client has a buy box that they have kind of committed to their investors, right? So they're saying we are going to buy properties that are valued at a certain level and that are certain bedroom and bathroom count. So it's very specific, right? And they also need a certain margin because the way that their financing works is to re-up their supply over time. So the equity component means that I have to buy the property at a level that I have enough equity to then get financing against it so that I can go buy more property. And if they can't do that, then it just doesn't work for their buy box. So
Right.
about 30% of the inventory in the country gets eliminated from their buy box for that reason, the lower segment of the inventory. And then there's another, 30% at the top end of the
Hmm.
segment that doesn't fit their buy box either. Um, and then we go into the general market, just home buyers or flippers, local
Yeah.
investors, local landlords, and they also can't buy it because the margins aren't right. They also can't get financing. If I want to live in an area where I grew up and the inventory in that area is depressed and in bad condition, then if I go try to get an FHA loan or USDA loan or any of the first time buyer type loan programs,
Mhm.
if the home is in disrepair, I can't qualify for the loan. So all of that housing stock that's sitting in disrepair, you have entire neighborhoods and areas, and anyone that's listening to the show can think of an area in whatever city or town they may be in that fits into this category of there has not been long-term viable purchasing and investment. We tried to fix this in the commercial sector with opportunity zones, to incentivize uh, your more commercial investors to enter areas that needed capital investment. But there's not anything that exists in single family rentals to do the same. And this opens up an entire segment of inventory, which encompasses about 30% of the overall homes in the country. That's a lot of property. And that is not even taking into account individual land, so infill building, which is a huge opportunity in the space for land that is still within margins that will work to buy and build individual properties or do modular or infill modular building as well. So you kind of unlock this is the keys I see it as the keys to unlock a segment of inventory where you can go in, purchase a property, renovate it to a really high standard, and then you improve areas without the gentrification process, without the rental, without this like
Right,
huge inflation
right,
that typically comes from an insert of capital investment over time. So this is I if you can attract enough capital to the segment of the market, my dream in this scenario is that we show the world what can be done with this type of like creative model, and then people copy it, and it becomes a viable way to add supply to the market in a way that remains stable for the residents. Like I said, that nonprofit ownership
right.
maintains affordability for the
Maintains
long
it.
term,
Mhm.
and also can improve areas that are and used to be vibrant communities that are just in need of capital investment.
Mhm. So is it, a capital investment? They've had some historical disinvestment.
Yes.
They if I can kinda, like, just categorize this, and then they still have space to build. So whether that is, you know, however you're coming up with that GIS mapping to say, "Hey, I've got tracts of land," or "I've got underutilized land," however that's it's going to. Is there a, specific, like, market that you're saying you wanna be in, maybe either through investors, like you've brought in certain investors, or whether you're just saying, "I know this market is, um, fast track permits," or, whatever your criteria is, like, how are you looking at trying to go into those markets, and what do those markets look like for you?
Yeah, my background is I would consider myself a tertiary market expert. I love tertiary. I built my career in third tier markets like Columbia, South Carolina, Greenville, South Carolina, Augusta, Georgia, Macon, Columbus, Alabama, parts of North Carolina. Um, so I like those markets, and if we end up the route of our own capital in Bear Impact and we start investing, we'll start in our core markets. The beauty of the model is that it works everywhere. And the reason it does is because you're dealing with single family rentals, which are exponentially easier because I'm just dealing with construction permits on individual houses, which are extremely faster to get regardless of the market. You historic areas and things with those types of restrictions, we would, for the most part avoid, um, unless we have, like, insight or intimate knowledge of those markets. But whether it is tertiary or primary markets like, Atlanta, Phoenix, Dallas, Houston, your big markets, all of those have the same opportunity as tertiary or individual markets because the gravity of our situation with affordable housing is that the supply is down everywhere. And the inventory is readily available
Right.
everywhere. So it greatly simplifies when we get into, which is the long term goal, more infill building. We would have to be more strategic about land use restrictions and things of that nature. But purchasing existing SFR is much more streamlined and
Mhm.
actually exponentially less complicated than development is. And so we definitely plan to use that to the advantage to scale faster. It gives us a lot of opportunity to scale at a faster rate.
Mhm. Let's talk about the capital intensive piece of this,
Yeah.
and because that is also what is so unique about what you're bringing to the table here and what Bear Impact Fund is doing. So, what are your goals related to impact driven housing paired with investing and bringing up that capital piece of this? Like, those are two unique things that are different than other models. So explain some of that for us.
So the goal was to be attractive to individual investors, and so the reason we have the three arms and kind of bring these two things back together. Um, the reason we have the three arms is for investability and for accountability. So the two major components that are important. The fund itself is lending money to the nonprofit, so it's structured debt back to the nonprofit. The nonprofit buys the home, and then the operating arms do the renovations, and then they
Uh-huh.
manage the property. They do the asset management so that you have professional third party management. These components are important for a variety of reasons. But if we're looking at it solely from a financial perspective, the first round of capital that we're raising into Bear Impact will also have a 20% equity stake in the operation. This incentivizes investors and aligns all of the interest appropriately.
Right.
So it gives them the ability to know that as the operation scales and the model gets larger, that their returns will also improve. And it functions as a quasi equity component. Because that was the initial knee jerk in the market is that I initially kind of soft pitched this to single family rental investors, and they are very accustomed to an equity component. And so they're like, well, what about the equity? And my explanation to them was, you can't have an equity component with the homes themselves because it is counterintuitive to the preservation of affordability long term, but you can have an investment in the operation, which allows for as income grows in that sector, that also provides more of a basis return.
Mhm.
It gives you really good, stable debt that is reliable and kind of bulletproof in a lot of ways in that direction because that leaves the opportunity for the nonprofit to then also capital stack within the nonprofit. So we can go get securitization debt, which for the audience is just a loan against the property's portfolio or the company's portfolio. And we're not gonna do it as aggressively as, or with the same types of margins that you would see in the traditional institutional space, but it still allows us to recapitalize a portion of the investment, buy more housing, which creates more stability for the initial investors. So that that kind of joining of arms of different models is really beneficial, and then but the long-term vision here then will show, a larger institutional partner, for example, how this would work within their current infrastructure. We would like to be at a point where we are just running the nonprofit operation, and we have a capital partner, an operations partner that are invested in, scaling this to a much larger level long term. So this is showing the viability of that, and then allowing for a transition period. Or if the cart comes before the horse, I'm okay with that too.
You talk a lot about affordable housing and financing and models and just kind of really real estate in several of your platforms. Why is that crucial, given that your audience it may or may not be on those platforms? Um, what do you view that to be doing for what you're trying to do with the capital fund and the investment pieces of this? It's kind of like inverse universes that are happening here, but so you must have a value set of why that's needed.
So my personality is very driven by long-term legacy. And I want to I get bored relatively easily, and like challenges, but I also like to approach situations as why not me? Because when you look at the problem, and that's what I initially did, was I just looked at the problem. I was like, this is a big problem. And then I started talking to people and they're like, it's a big problem. I'm like, I know, I see that.
Yeah, but a
And
lot of people talk about the problem, not the solution, and that's what you've been
yes,
able to create is
yes.
a model and an impact fund that goes to the solution. So that's the difference here, to give yourself credit, right?
Thank you. Yes. Um, so I really just want to spread awareness because I think that there's a lot of misconceptions, and there's misconceptions on both sides of the field. I've been trying to do work to connect industries together, and help them understand how each other operates, and how they are beneficial to each other. For example, if you're looking at, I mentioned two organizations, NRHC and NARO, right? They are both trying to do the same thing, which is
Mhm,
protect their residents.
mhm.
And they both represent a large number of residents.
Right.
51% of our country are renting properties. The issue is, if we're going on a legislation pathway, which I'm always happy to do, uh, this is a conversation of a lot of times residents are not viewed as vocal constituents, and
Mhm.
because they're not being vocal constituents in a lot of cases. And so the a lot of legislation gets formed around our old adage of homeownership being the American dream,
Right. Mm.
and which is still the case for a lot of people in the country. A lot of
Mhm.
people want to own a home, and some people don't. Um, and some people, are in a position where that would hinder them in some way. They want to
Uh-huh.
travel more or have disposable income to do different things. But we are in a position where we need for there to be better education and better, uh, kind of aligning of interest so that people don't have demonized sides of
Mhm.
industries. The affordable housing industry gets demonized a lot.
Mhm.
Um, Housing authorities at large are misunderstood. And like any organization or industry, we're all fighting some type of barrier, or we're trying to improve or iterate or make things better, while having to deal with red tape and issues that a lot of people don't understand. And then the institutional side of the industry gets demonized because they are looked to as you know, it's easy to throw a stone at Goliath, right?
Mhm.
Like
Right.
it's the easiest thing to
Right.
do,
Right. Or
is to say
somehow
like,
along the way, you know, profit and investors, it became the dirty word or something like it
yes,
became bad to try
yeah.
to reduce risk for people who are investing their private money to make this work. Yeah.
Yeah, and,
Mhm.
the truth of the matter, you have to have capital to scale and solve
Right.
problems. if you can't get capital to understand and get interested in an industry, which just comes with de-risking, explanation, um, having very intentional and specific investment criteria and goals and all of the things that speak their language,
Yeah.
and put them in a position where they can make a safe and viable investment for the people that have trusted them
Hmm.
with their money. And so you have to have this, like, aligning of interest that includes those industries, but it also includes my friend I went to high school with, right? Like, or someone that's in a completely different
Yeah.
industry because there's not enough good education on why we have the issues that we have in housing.
Hmm.
Um, eh, and it's such a complex issue that people want to assign blame, and
Hmm.
for good reason, right?
Hmm.
Because it's such a big problem that they're like, well, the government should fix it, or
Right.
these investors are causing the problem,
Right.
or we can go down the rabbit hole of taxes and zoning laws and regulation being the problem, or redlining from when we had
Yeah.
redlining before being an issue, income growth, which is a huge concern, and a viable thing to bring up in the conversation. All of those are components of what's happening. But if we just keep talking about all the problems, and not trying to say, okay, well, how do we maneuver around those? How do I try to make legislators happy and private capital
Yeah.
happy and nonprofits included in the conversation, and get everybody in the room together to, like, really look at how do we join forces to solve the problem? Then we're never going to get anywhere. So that's probably my biggest passion long term is, hopefully being a change maker in that regard.
Yeah. Well, the platforms you're on are surely a conduit to help you get that message out too. But it's a complex world when you're trying to address multiple dynamics, multiple cities, and then it's just. I think when you gave the example of renters not necessarily all them being mobilized into a group of people that like, when you said that, it was a moment that said, "Okay, that is part of the problem here too," is that you have, um, workforce housing, you have senior housing, you have veteran housing, you have extremely low income, like, there and so because it's such an interesting group of people who need affordable housing, there hasn't emerged one voice necessarily to be able to
Mhm.
say, "Hey, as a collective, we need something to happen because rents at $3,500, how much longer can this go on?" And and maybe it's more that the housing policy has been housing policy, but it hasn't been economic policy.
Yes, exactly. And that a wonderful point because there is, also, if we're looking at our residents, like the
Mhm,
resident issue and rental price inflation over time. I can look at both sides of the industry. Let's take LIHTC first.
mhm,
LIHTC developers have struggled, in recent years. When I went to WAN, like Women Affordable Housing Networks conference, a lot of conversation was being had around, oh my lord, like, our pricing is just getting out of hand, like, we're
mhm,
up to hundreds of $1,000s per unit because
right,
we've got all of these things. Construction's gone up and permitting's gone up, and a all these things are adding to cost, and so they're struggling to pencil deals and to keep
right,
institutional investors interested in the space because costs are getting out of hand. And then if we're looking at the market rate housing, in SFR or apartments or otherwise. I can tell you as an analyst, what the majority of the market doesn't realize is that over the course of my career, let's say 15 years, the overall expenses attached to managing and operating a single family property or a rental property in general have increased upwards of 40%.
Uh,
So, our taxes have gone up,
uh-huh.
permitting has gone up, cost of material has gone up, everything has gone up. So, while wages have stayed relatively stagnant.
Uh-huh.
Um, and so there is, it's an easy thing to say, we're not building enough affordable housing, right? We need to build more. Without understanding the complexities of how those loans work and how to pencil a deal and what
Right.
you have to get your dirt for and, all how to get through permitting and find somewhere that they'll let you actually build it and all of those things. And then in the opposite sector, it's easy to say investors are being greedy and they just,
Mhm.
they want more, more, more.
Right.
When if you look at the actual deal dynamics, the deal dynamics are about the same and they've just adjusted themselves over time to try to keep up with the increased cost.
Mhm.
So you've got to have a healthy medium that helps balance this out. And the only way to do that is with a hybrid model,
Mhm.
because it will empower both sides of the industry,
Right.
and it most importantly will empower the residents to have more flexibility in the way that they move through the market.
Right.
I don't want a resident who's living in a income restricted property to be afraid to take opportunity,
Right.
which a lot of times is what
Right.
happens because if I'm going to get a raise, but it's only a $2 raise, and
Yeah.
that $2 raise could lose me my housing,
Yeah.
then do I really want the $2 raise because I
Right.
can't find anything
Right.
affordable? So there's a lot of complexity there.
And when you even layer in the punitive aspect of savings, having to have a savings account, pay down debt, right? Car repair, you pay it, you do it with a credit card and then you pay off the credit card. Well, you want to have the income increase to be able to pay off your debt. But now, wait a minute, I'm actually not paying off my debt because my rent went up. Like, there's pieces of this that are not making sense. And nowhere in that model does it really account for that. I mean, medical debt aside,
Sure.
things like that. But I mean, like car repair, a really dynamic of having to make ends meet. So, um, and the current model just doesn't really provide for the person to get to that next level of economic attainment. Yeah. And
Mhm.
that's what you're doing here is that you're saying, "Hold on, we've got a model here that can still address affordability, still bring in private capital, still be accountable through the nonprofit and all of the dynamics of that, and yet doesn't boomerang against the person who this was intended to benefit." Did I
Exactly.
summarize that correctly?
Yes. It
Okay.
was beautiful. Better than I could say it.
Well, I mean, like, the policy is what the policy is. The regulations are what they are. And that is fine for the day to day. I mean, we're in the business, like
Yeah.
we're in the business of making sure those regulations are compliant and they're doing what they're supposed to do. But it clearly is not enough. I mean, we have like 20 and 40,000 people on waiting lists.
Mhm.
So it's not enough. So what you're bringing to the table with Bear Impact Fund is bringing a whole new menu here to the table, and that's what I believe you as founding and managing partner here. I'm happy to have had you on the ChangeMakers podcast. Is there something we did not cover that you really want to say here? Because we could go on talking about this unique menu on the table here for quite a while. But anything else you want to mention before we close out here?
I'll just leave people with I think we all have to collaborate more. And so I would welcome anyone to add me on LinkedIn, Lauren Taylor Dreher. Uh, and if you want to talk about things that you're working on, I'm excited to do that. Every segment and all of the people that I'm meeting since I've been in the affordable housing sector has been very invigorating and just bringing new energy to me. I very good at a segment of business that I did for a long period of time. And so this is humbling in a lot of ways. I've got to learn so many new things. And I'm just excited to try to be here to help be a part of a solution and a group of people that are all working towards that.
Well, Lauren, thank you so much for the time. I know our listeners are going to be eager to hear this creative model that you are working in, and we'll keep spreading the information so you can have plenty of tools, investors, and markets to make all this work. So we want to magnify that and make sure that you keep moving that forward. So thank you so much, Lauren.
Thank you.
Thanks for listening to Changemakers with Katie Goar. To find out more about Katie, go to quadel.com. That's QUADEL.com. This has been a production of Forbes Books Radio.